Hi, this is Hutch with bankingtruths.com, and today we're going to talk about some new modern day techniques to design an age-old product like whole life insurance so you can enhance your overall performance and have the ability to front load additional cash into the policy early on without turning it into a MEC, a modified endowment contract, which obviously revokes some of the best tax advantages that are afforded to whole life insurance. Now, in order to do this, we're going to reference that old 1980s study. If you haven't seen it, I strongly suggest you check it out because at the very least, it'll give you a glimpse into how rising rates can affect a whole life policy. We can only illustrate up to what today's current dividends are. With that, let's take a look at that old 10-pay policy. So a 10-pay policy is basically the present value of all future payments paid into the first 10 years. And you bring it right up to the MEC limits. In this case, we're talking about a 50-year-old standard non-smoker, $14,445 premiums. Now, we're going to use the exact same cash flows into our kind of, call it quasi-synthetic 10-pay. Ours is actually a more flexible life paid up to age 100, but we're using a term rider and a PUA rider to stuff in that full present value, the same $14,445 into our policy. Now, what's nice is you have flexibility with ours, whereas you don't with the 10-pay. With the 10-pay, the premium is $14K, whether you got it or not for 10 years. And after that, you can't put anything in. Versus ours, your minimum premium will be about 25 to 30% of that maximum. So call it, $3 to $4 grand, somewhere in that neighborhood. Depends on how old and what rating you get. And if you want to pay longer than the 10 years with ours, you actually can. You may not be able to pay the full maximum, but you can at least pay something if you want to continue to compound cash value inside your own private bank. So if we just cut to the chase and look at year 42 of this old 10-pay policy, you can see that it ended up with $637,000 of cash value, $702,000 of death benefit. Now, what's interesting is our policy at today's dividend rates, which, by the way, are much lower than that 1980s policy. The 1980s policy, the dividend rate originally illustrated at 8.27%. Ours is at 5.75%, and yet we end up with $702,000 of cash value. Now, that number probably sounds familiar to you. If you remember, that wasn't the cash value amount of what was originally illustrated in the old 1980s policy. That was the death benefit, which always has to be greater than the cash value in order for it to qualify as life insurance and retain all of its tax benefits. So that's how much cash value we have. We actually have $775,000. Now, who knows? One thing for sure we all know about every illustration you can ever see is for sure they will all be wrong. Why? Because we're showing one steady dividend rate for perpetuity, and interest rates, dividend rates ebb and flow over time. We know this to be true. No illustration has ever been exactly the same with a participating whole life policy with fluctuating dividends. Just hasn't happened. So what happened in that old 1980s policy where they illustrated to have a lot less cash value, 637? Well, they ended up with 1.194 million of cash value, or 87% more cash value than what was originally illustrated, with an 8.27% dividend. And if you remember from the old study, by the time you got from 1980 to the year 2000, it was already back. It had spiked up for a while and trended back down. It was already back to 8.3% dividend, almost the same exact dividend. And from the year 2002 on, as you probably remember in your own experience, interest rates kept falling and falling, and therefore so did dividends. And they fell from 8.3 all the way to 6, which is where this current company has their dividend at right now. So pretty profound, right? We're starting with a lower dividend rate, and yet we end up with more cash value. And that's simply because of a leaner, meaner base policy and better design techniques. Let's take it a step further and show you how we can front load instead of staggering these payments over 10 years, which I realize some of you might have to do. What if we could stuff them in even sooner? Does that make it better? I think you know the answer. All right, so if we use our synthetic 10 pay as the baseline, the $14,450 of annual premium for 10 years, it's going to equal $144,500. We can see, let's just look at year 11. We get to $175,000 of cash value, $323 of death benefit. Now, if we take the same total premium, $144,500, and slam it in the first 7 years, because if you have heard the MEC test, one of the tests are the 7 pay tests. It's the most amount of premium or a lifetime's worth of premium into a present value of the first 7 years. If we put that $144,500 in here, we don't get to $175,000 of cash value. We get to $187,000 and $346,000 of death benefit. Wow. Okay. Can we stretch this even further? Well, you'll be surprised to see that if we take it all the way up to a $30,000 maximum front-loaded premium, where we do 4 times of 30,000, that's 120,000, then 8,500, then 8,000, then 8,000. It equals the same $144,500, but instead of 187, we get to 188,000 of cash value and 349 of death benefit. Now, there are trade-offs to doing this. So one of them is you have to, in order to get that much premium in, you have to have a bigger death benefit. And some of it can be comprised of cheaper term insurance, but you do have to pay for a bigger base, which some people have read, I don't want more base. What you're seeing here, though, is in spite of paying for more base, significantly more base, you are ending up with more money. Why? It's because the compounding effect, the time value of money, more in sooner is better, as I always say, because that's getting in there earlier, it's outrunning that early erosion from base. And we're going to explore that further in a further video. And so we look for sweet spots. So if we just look at a tweener design, what's interesting is by backing off the 30K design, like if we look at the 30K design for just a moment, if you remember, it had the most cash value at year 11. It was $188,793 and $349 of death benefit. By doing a $25,000 example, we get to $189 of cash value and $349,878 of death benefits. So a tiny bit of optimization, a little bit of a tweener. And the only, let's just say, downside to downsizing from the 30K to 25K is you do squash future capacity. So if we look at all the future capacity, when we start to fill up this policy, so to speak, is you can see the premium numbers go down and they get to these weird little odd numbers. That's not our design. It's just that's the solve for the maximum non-MEC premium. You can see that is a lot smaller than with the 30K design. And if we compare the 7-pay design and the 10-pay design with the smaller base and everything else, you can see your future capacity also goes down. So again, this is what we help our clients do. Once they kind of understand the underlying dynamics of how these things work, kind of we call it the field goal, the minimum premium, the maximum premium, they find kind of field goal posts that they're comfortable with. We will help them fine tune to get to the right Goldilocks number for them. So if you're interested, I strongly suggest you use the link below to book a call with one of our pros, and we can help you do that with your numbers. Look forward to more videos. We're actually going to go into paying for that extra base because people think it's bad and what you get for it. And I hope you enjoy this whole series, and I hope to talk to you soon.